The U.S. stock market, as represented by the S&P 500 index, is near an all-time high. The topic for today's video is how much earnings growth is the current market price anticipating? Is this implied estimate of growth reasonable? And if not, what are the consequences? In my last video, I did a deep dive on the intrinsic valuation of stocks using the PE ratio. And I pointed out that one of the key aspects to valuing stocks, particularly an index like the S&P 500, is determining what the cost of equity is. And in that video, I went through a pretty detailed discussion of how you determine a reasonable level for the cost of equity. A reasonable level for the cost of equity today is probably somewhere in the order of 6 to 7% in real terms. In other words, in inflation adjusted terms. If we use the lower 6% number, which would be more optimistic for stocks, what that implies is that a normal PE for the S&P 500 would be roughly 16.67%. That's the forward PE ratio. That would be the fair value forward PE ratio, assuming normal earnings. Now, what is normal earnings? Normal earnings is not average earnings. Normal earnings refers to the fact that stocks on average will not earn more nor less than the cost of capital in the long run. And this is well supported historically, and it's supported by economic theory. In the long run, the average of stocks in the market should not be able to earn abnormal returns, i.e., returns on their investments that exceed the cost of equity. Therefore, a reasonable estimate for the fair value of the S&P 500 would be roughly 16.67%. Now, the current multiple for U.S. stocks is about 28 times trailing GAAP earnings, or about almost 26 times the trailing operating earnings. So this is a huge difference between a fair value normal PE and what the PE actually is right now. The question is, what is this implying about what the market thinks about growth or what it thinks about the equity premium? Because this very elevated PE ratio is indicating that the market is either assigning a very low equity premium, which is meaning that it's assigning a very low risk. It's not discounting for risk in a manner that it normally would, or it implies that the market is anticipating abnormal growth. By abnormal growth, I mean growth that is generated by investments by companies, internal investment by companies that achieve a rate of return that is significantly higher than the cost of equity. And as I mentioned before, that generally can't happen on average, but it could happen for fairly short periods of time. The market seems to either be anticipating extremely high abnormal growth in the next few years, or it's expecting relatively low amounts of risk. Now, I'm discarding the possibility that the market is discounting low amounts of risk for one reason, because we can look at different risk premiums in the market. Perhaps the most commonly used risk premium in the market, the premium that most people are familiar with, are corporate bond spreads. Corporate bond spreads reflect the difference between risk-free government securities and the yield on government bonds. Those spreads are actually quite low right now in historical terms. They're not at all-time lows, but they are relatively low compared to history. However, the equity premium that I'm implicitly assigning in the 6% cost of equity figure that I mentioned, that equity premium is about 4%. And that's historically also quite low. Historically, that premium has been closer to 5%. Therefore, the cost of equity estimate that I'm using to get this normal fair value PE of 16.67 is already assuming a pretty low equity premium or risk premium. And that coincides pretty well with what the bond market is telling us. But going any lower than that is probably not very reasonable. There's very little evidence to suggest that the market is pricing risk so low that it would justify going from a forward fair value PE of 16.67 to a forward PE right now on GAAP earnings of about 25 or a forward PE on operating earnings about 22. That's just too big of a difference. And so we know for this reason that virtually all of that premium that we have in the market right now to the normal fair value PE is being caused by extremely high expectations of abnormal growth. Now, just how much abnormal growth is the market expecting? Well, I'm probably going to do a video fairly soon where I go through the calculations and show you how you can actually calculate the implied growth that the market is expecting over a given period of time. But without going into the specific calculations right now, what I can tell you is that assuming that cost of equity of 6% and assuming that the risk premium that the market is currently assigning isn't any lower than the one that I'm already assigning in this 4% risk premium that I include within the 6% cost of equity, the growth rate that the market is implicitly pricing into the market is roughly 16% earnings growth every year for the next 5 years. That's 16% nominal, 14% real. Now, that is an unrealistically high amount of growth. And to illustrate to you exactly why that's so high, one of the things that we can simply look at is what is the long-term historical average for real growth of earnings in the S&P 500. The long-term average is somewhere in the neighborhood of about 2.5% real. Okay. So when we're talking about 14% real over a 5-year period of time, that is out of whack with historical averages. Now, what's even worse is that, and I'm going to show you in a table that I'm about to present to you right now, that what I looked at was what is the amount of growth that usually happens 5 years after an economy attains full employment. Because when an economy attains full employment, it usually starts growing more slowly. That's logical, right? If you've hit full employment, companies can no longer have the ease to hire a lot more workers to increase production and to increase sales. When you're early in the cycle, there's a lot of slack in the labor market, and there's a lot of employees that you can hire to raise your production that'll increase sales and increase your profits. When you're late in the cycle, you can't add, the economy as a whole can't add that many workers, and therefore the markets as a whole can't grow its earnings all that fast. Now, I made some really conservative estimates of what full employment is in accordance with the way the government estimates this. However, I actually think that full employment is actually a lot lower than what the government estimates. But to be extremely conservative for purposes of this video, I just went ahead and went with the government's numbers. And what you're about to see is that never before in history, since World War II, has the U.S. stock market grown for 5 years straight, or an average has never obtained a 5-year average growth rate of earnings of 14% after it reaches full employment. It's never happened. In fact, the median and the average are much, much lower. Now, let's take a look at this table. And what I really want you to focus on is the 5-year EPS compound annual growth rate after full employment in each cycle here, essentially since World War II. And what I want you to look at is the following growth rates. There's not a single one of these growth rates here that's anywhere near 14%, with only one exception, which was the growth rate that we had starting in January 2017 until after COVID. Now, this extraordinary growth rate was caused by the massive amount of fiscal stimulus, the stimmy checks, the massive amount of QE, of government money printing that happened right after COVID. This really juiced the earnings of US companies. But this is a non-repeatable situation. That's never going to occur again, or it certainly doesn't appear that it's going to occur in the next 5 years. It would be an unreasonable expectation. But even that very unusual situation produced a growth rate that's less than what's currently anticipated by the market. And by the way, that also caused a massive rally in shares to almost record high valuations. It would be hard to anticipate that the market would go on such a tear from the current levels. But what we see here is actually pretty modest growth rates, even negative growth rates in various 5-year periods after full employment has been reached. In fact, one of the things that tends to happen when you're late in the cycle after you've reached full employment is that you very often get to a recession fairly soon. And for this reason, you get some pretty big declines in earnings from the peak of earnings during the cycle until the trough of earnings during the cycle. And that's what you can see here in this column that says cycle peak to trough EPS decline. So from the time of the EPS peak during an earnings cycle to the trough, you get declines that are generally well over 20%. And they almost always happen within that 5-year period after the economy reaches full employment. So if anything, right now, we need to be thinking, if we're thinking 5 years ahead, that we might be facing a collapse of earnings associated with a recession, because usually recessions happen within 5 years of full employment being reached in the economy. So for various reasons, it's very unrealistic to expect a 14% real growth of earnings over the course of the next 5 years. Relative to history, it would be extremely unusual. Again, growth has been something like 2.5% historically in real terms. And after the economy reaches full employment, that figure is even lower. So we have 3 questions that we're trying to answer in this video. The first is, how much growth is implicitly being expected by the market right now? We've already answered that question, about 14% real, 16% nominal. Second of all, is it reasonable for the market to be expecting this type of earnings growth? The answer is absolutely not. There is very little reason for the market to expect, particularly based on historical precedent, that type of extraordinary abnormal growth. So the third question is, does it matter? What is the practical significance of the fact that the market is expecting such extraordinary abnormal earnings growth? Well, in the short term, it doesn't necessarily mean anything. People are optimistic about the growth of shares, particularly about the growth in the so-called Mag 7 stocks such as Google and Microsoft and Amazon. And that optimism isn't going to just disappear overnight. It would only be over a very long period of time, let's say over the course of 5 years, that people might be disappointed. Over the course of the next 5 years, people are very likely going to be disappointed with earnings growth relative to the expectations that they have today. But that doesn't tell you anything about timing, about when this disappointment might occur, or how violent of a reaction the market have to that sort of disappointment. This could just be a slow grind in which the market either fails to rise or just sort of declines and drifts down gradually over time. It's simply not possible to make a short-term prediction by observing that the 5-year growth rate that the market is anticipating, the 16% nominal and 14% real, is very high and likely to be disappointed. However, there is a very practical implication to this, which is that these extremely high expectations for abnormal earnings are setting the market up for a big potential disappointment in the event of a macro-driven event that causes people to readjust their expectations downward. In fact, what we saw there in the table that I just showed you is that when you have recession, not only do you not have growth, you almost always have a huge decline in earnings. The declines in earnings that happen during recession are generally more than 20%. So if we go from expecting extremely extraordinary abnormal growth to a scenario where all of a sudden investors start discounting a collapse in earnings, that will have an enormous impact on the market. That will cause stocks to most likely go into a bear market. It will most likely cause shares to fall by more than 20% from their peak. Now, I've discussed in several of my other videos that I think that there's a very strong possibility that we're going to get an oil-related shock in the next few months, and that oil-related shock could send shock waves through the entire economy and potentially trigger a recession. Because normally when you get an oil price shock late in the business cycle, it triggers a recession. Now, I could be wrong about that, and we'll just have to see about whether we get that oil shock or not. But if we do get an oil shock that triggers a recession, it's going to cause a violent reversal of expectations from ridiculously high expectations of earnings growth during the next 5 years to very low expectations of earnings growth to expectations of a big decline or even collapse in earnings. And that type of violent shift in expectations would produce a violent decline in stock prices. Now, when you're looking at the price of any individual stock, the price of that stock is always going to be set by the most optimistic investors. Why? Because the market is an auction and the stocks are always sold to the highest bidder. The people who own shares are a very tiny minority of people, and that tiny minority of people are always the most optimistic. Now, today in the stock market, there are a lot of narratives surrounding AI that are making this very small group of people that are very optimistic. It's making them even more optimistic than usual. It's making them extremely optimistic. And this accounts for the run-up in prices, particularly amongst the Mag 7, that are causing prices to rise so high. And these high stock prices reflect precisely this absolutely exuberant optimism regarding earnings growth. Now, that optimism is going to stay in place, at least for a while, unless there's some sort of catalyst to shake that up. It's not going to be an individual stock catalyst. It's not going to be a catalyst related to AI specifically, because there isn't going to be any bad news about AI in the next few months or even the next year or two. There can be debates about AI, and there's going to be some people that are going to be saying that AI isn't going to generate all the earnings growth that people are expecting. But those relatively pessimistic opinions aren't going to matter. The only opinions that are going to actually matter are those of the most optimistic people. And I don't see any prospect for the most optimistic narrative surrounding AI and earnings growth to be punctured unless we get some sort of a macro catalyst like an oil price shock. If we get an oil price shock and we get really big slowdown in economic growth or a recession in the US economy, then people's very high expectations of growth will be punctured. And that's when we could get a particularly big market decline. So that's where I want to be very clear. I'm not predicting right now a big market decline. All I'm saying is that the market is perfectly set up right now for a big market decline in the event of an important macro event that either causes a big slowdown in economic growth or recession, which in turn causes a big adjustment in earnings expectations. So I want to leave you with 3 action points. The first is, if you're interested in knowing how I am using these ideas in the construction of my own personal portfolios, please consider subscribing to my Seeking Alpha service called Successful Portfolio Strategy. I have a link in the description. Second, I have a free newsletter that I send out where I send out my articles, my writings, I send out interesting material. And also, by being a subscriber to this free newsletter, you get access to a community that I'm getting ready to start in the next week or so, where all of the members of my free newsletter can come in, ask questions, chat with each other, and chat with me, because I will be frequently interacting with you in that chat to answer questions and to discuss topics of interest. And finally, subscribe to this channel because I'm going to be in the next few weeks following very closely a series of events that could potentially lead to the type of disappointments that I just alluded to here. I'm also going to be going into greater depth about the subject of valuation and how to value stocks and how to know whether a stock is overvalued or not, or whether it's undervalued, and also to be able to figure out what that actually means when a stock is overvalued or undervalued, because you can determine that a market might be overvalued on the basis of some criteria, but value doesn't determine price. We need a link to link concepts of intrinsic value or fundamental value and price. And that's the link that's missing in the analysis of most folks. And so that's going to be one of the main areas of focus that I'm going to be focusing on in this channel. So please subscribe to this channel and I'll see you soon. Thanks.